Hello everyone and welcome to my channel, and today we are going to discuss about what is GDP and how it affects the stock market or vice versa, how stock market affects the GDP. So let's get started. Before that, subscribe to my channel and let's get into it. Okay, let's understand what is GDP. Okay, gross domestic product. GDP is the total monetary or market value of all the finished goods and services produced within a country borders in a specific time as a border as a broad measure of overall domestic production. It functions as a comprehensive scorecard of a given country's economic health. So it's basically a scorecard, you can say, of a country of what is the total market value of the finished goods. Okay, not the middle goods. There are actually industrial products, middle products, and the finished goods. Okay, raw materials come to industries. Industries make the product, and the product goes to the market, and that's the finished product. Okay, that the customer purchases. Okay, customer, industry, and the raw materials, this to this. Okay, this is how what is GDP means, and let's get into another effects of buying. What is the effect of buying? Okay, effect of buying means, as I have said in the earlier video, that let's suppose I'm taking here also. Well, what happens to the stock market when there are more buyers? Okay, the stock market goes up. Simple. What happens when there are more sellers? The stock market goes down. Okay, so let's understand what happens, effects of buying. Okay, buying in the sense not with the stock market, in the real world also, that when customers or the people are buying more products from outside also, what happens, customers can spend more, businesses can invest more, and the product sales increases, businesses can invest more, product flow in the market increases. Okay, why? Because businesses can invest more, and because that's why businesses can develop more products. This increases to the supply of the product, this increases the demand of the overall the GDP will increase. This is a positive side. Okay, this is the positive side of the market, that this will this how the GDP increases. Okay, eventually GDP will rise. This makes the stock market rise too, because because people can afford invest more. Okay, why? Because as people are investing in the products or buying the products, people must go for money instruments also, like the stock market, like the fixed deposit, like the mutual funds. Okay, so what happens, the stock market price will increase. What many people buys in mutual funds, and mutual fund companies are big financial institutions. They pool the money from the people and invest in the stock market, and what happens, this will make the stock market rise. When the GDP rises, stock market also rises. Okay, so let's get into the next one, effects of selling. Okay, what are effects of selling? As I have said earlier, when the buyers are more in the market, market goes up. When the sellers are more in the market, market goes down. Okay, so what happens in the effects of selling? Selling means, suppose recession, you have a property. Okay, and there comes the recession, say 2008. Okay, so what happens, people started to sell their assets, sell their every investment to sustain a living. Okay, because the product prices are very high, because people, because of some because of some reason, economy cannot grow well. Okay, because of economy cannot grow well, people cannot buy new products, and because that's why recession happens. Like the housing thing happened with the USA, and that crashed the market. Okay, crashing may happen with the recession. Okay, recession means when the stock market crash, everyone is like, what will happen now, what will happen now? But there are many people also who see this as an opportunity to invest. Why? Because the stock prices were undervalued at that time. Okay, when they hit the support levels at that time, many people invest. Okay, many financial institutions, if they have cut it off their holdings at this level, this will eventually go down to this level, and they will invest here. What will happen? They will take the profit from here, and this will go rise. Okay. Okay, what next one? So let's see next one. People tend to sell their assets. As I've said, people tend to sell their assets, and what happens in selling? Market goes down. Simple. This leads to devalue. GDP falls. GDP falls, many reasons. Business, more people cannot afford the products because the product prices are too high. What happens if the product prices are too high? Demand of the product gets decreased, has the inverse relationship of demand and supply. Okay, what happens? This is normal world. Okay, normally I am saying. So what happens with the share market? People, of course, if they are if the normal products prices go high, there is a rate of inflation, no jobs will be there. No jobs. Okay, let's suppose one, no jobs, no money. How can people invest? GDP goes down. Okay, as because of investment, people earn money. Okay, eventually stock market falls. Okay, impacts may be anything resulting to fall, like COVID-19. People has lost jobs, people has lost many things. Okay, people has lost lives also. So this happens when the effects of selling. This is the simple and logical explanation of what is GDP. And do like this video and subscribe to my channel.